Welcome back. You're tuned into Trading Hour, and let's get a conversation going on where the markets could really be headed. We have Vikas Khemani joining us. He's founder at Carnelian Capital Advisors. Vikas, thanks a lot for taking out the time to speak with us today. This is Pavitra. You know, it's really beginning to feel like that market which is just dragging, right? And we've been talking about how the pain in the broader markets is even more than what's perhaps evident on the frontline index. Can you tell us, in a market like this, are there still pockets where you feel you're comfortable putting fresh money to play?
Hi, Pavitra. I think, whatever we are seeing in Indian markets are, of course, the result of what's happening globally, especially in the SVB and Credit Suisse crisis, and that had an impact. And these are the very large events at the global level. So, of course, right now, a bit of a risk-averse environment is there. But as far as India is concerned, while could be some slowdown in growth of some sectors from short-term perspective, we think that these are the times when there's a lot of uncertainty, a lot of worry in the market, are the times to deploy capital, because that is where you get same companies which were available at 30-40% higher price only 2 quarters ago, a couple of months ago. So, if you believe in the long-term fundamentals of any company and long-term opportunity, I think, you've seen sizable valuation correction across the board. So we are finding lots of interesting names and opportunities, and we are deploying capital on a regular basis in these kind of markets.
Vikas, hi, good morning. A slightly different question. You interact with HNIs at a regular basis, and people basically who've got the money, right? What are they thinking? And more importantly, what are they doing? Because so much is changing. The equity market hasn't been easy last 12, 13 months. And then you have these major tax changes happening on the mutual fund side. Plus, yields are still attractive at 7% plus if you're looking at other instruments. So is the equity market, at least in the last couple of days, is it also suffering because of some of this money moving around?
These are the very substantial changes which have happened, especially where a lot of HNI money was deployed. So, of course, some amount of shifting possibilities happening, fixed income attractiveness has gone up, and hence some people have moved towards that. That's all real, right? And especially also one thing is that the human mind always sees more risk. If there's a risk in the recent past, and if there's a return, then you see more return in the same way. So last 1.5 years, money has not been made. So people are thinking that, oh my God, we thought India is great and still money has not been made. But what we don't see is the context and environment where, once in a 40-year kind of things which have happened, interest rates have risen so sharply in the shortest period of time. And despite India's holding on, it's a great outcome according to me. In equity always delivers returns in step function. It is never linear. So, right now, it is no doubt that the people who are deploying capital, but the proportion of that is reduced. I guess till the time worry or fear settles down, you might say still remaining tepid, but it's, in my opinion, 3-4 months away. Market might go through side corrections, but money would come in, I have no doubt in my mind.
Exactly on that. Let me ask you a follow-up. Now, could the converse become true? I'm just trying to be an optimist here. Now, you can't invest in MLDs. They're no longer tax efficient from the 1st of April. You can't invest in debt mutual funds because they don't have the tax advantage. So can some of that money start moving back to equities? I'm just taking a reverse argument, trying to be optimistic on the equity side.
Yeah, I think everybody works based on the asset allocation. Of course, net returns post-tax has some impact on, allocation at the edge. But let's say, hypothetically speaking, based on your risk statement or your return statement or your policy statement, if your debt equity allocation is 50-50, let's say, because of tax, you are not going to make 100-0. You might make 55-45. So 5-10% plus minus here and there can happen. My fundamental belief is that, over the years, that is the guiding factor, and that allocation will remain irrespective of what the returns are. There was a time when fixed income return went down as low as 3-4% post tax and 5%, and still debt allocation was very large. So that doesn't change much, in my opinion. And equity, we have known that over a 20-year period has given 17-18% IRR. So equity is a very different, non-linear equity return asset class, and most people understand that, and hence I don't see a major shift of that.
All right, don't see a major shift on account of this. Vikas, short chat today, but we're going to have to leave it at that. Hopefully, we will be able to talk to you soon in the coming few days on where you see the market.